Yeah. I think right now Verizon is one of the best opportunities in the market considering where they're headed and how much they can actually capitalize on this transition to 5G. Like I have 5G home internet. It's from T-Mobile, but it is amazing. Like the level of complexity needed to get started is so low. The complexity needed to get it up and running like from the business standpoint is super low. So I think this is one of those times where we're going to see an incremental shift away from like cable TV into 5G home internet. It's super speedy and the cost is way better than cable. I know people that are paying like 120, $150 for cable internet and it's just like why? And now Verizon has they bought a lot of something called Spectrum over the last like couple of years, and now they're finally going to be able to monetize a lot of that spectrum. So a lot of the services, like a lot of people are like, well, I don't have home 5G like near me that's not available. It's going to start making its way into the availability pool for a lot of people. A lot of that was primarily because you had to do something called spectrum clearance so that the like signals don't interfere with each other. And so the FCC had this giant auction and Verizon came away with a large part of that spectrum. So it'll be interesting to see where they end up going, but I think they're going to do very well. You know, I know Steven's got this whole presentation on Verizon, so I'd love to see that. And then,
Yeah,
uh,
I'll
yeah,
stop doing the read stuff and I'll do
yeah.
it the last two columns live.
Okay.
But I'm going to echo what Chris said about Verizon. It's past 10 p.m. Still drinking coffee as I'm
Smart
fucking
man.
savage. Um, so Chris alluded to something on the finance junkie stream. Yes, I understand. Let's proceed to share this.
Can you make it, yeah, one screen, Matt? There you go.
Sorry.
So I'm going to increase it. Is that good? You want me to go one more time?
No, I think that's good. I could see it, but there we go. That's better. That's better.
All right. I just want to see what it looks like one more time for the
Okay.
viewers.
That looks even better.
Okay.
It's beautiful.
All right.
Yeah.
So Chris knows, and I'm sure Matt knows how I look at things by now. So I'm very numbers driven. So Verizon and AT&T are both tremendously undervalued, in my opinion. But Verizon is very interesting here as well. So, they have not reported yet. So I'm using the trailing 12-month numbers. They're trading at just under 9 times their free cash flow. You show me a business that's generating $15 billion a year in free cash flow, and you're paying high single digits. That is crazy, considering T-Mobile generating just over $4 billion, and they're trading at 37 times. Now, I looked at the forward EPS for each of the companies for 2023, 2024, and 2025. Verizon is trading at under 7 times their forward PE for the next 3 years. Now, the market, I believe, doesn't necessarily like Verizon right now because of their debt profile and because there's not a lot of earnings growth on the horizon. People are misunderstanding the debt profile and actually broke everything down. And what Chris had said before was 100% true, that Verizon is trading at a lower PE than their dividend yield. So Verizon's paying $2.66 dividend. They just increased it. It's an 8.5% yield, and it's less than 60% of their forward EPS on 2023. So super high yield, great payout ratio, leaving a lot of room for debt. Now,
One thing, Stephen,
go
and
ahead.
I was listening to the last conference call. They are so committed to keeping that dividend exactly where it is. Like one of
They
the things that
just
they're
increased it 2
prioritizing
weeks
is that.
ago by
Yeah,
4 or 5 cents.
yep. So that's the thing. When businesses project out that they're, going to maintain their dividend, they typically do that. So if they didn't see the forward cash flow in the future, they wouldn't have gone to that length to just say like, no, one of the priorities that we always are going to have is the dividends. And I think a lot of people are expecting Verizon to cut their dividend when I don't think that's even necessary or a reality.
Yeah, so let's stick on that for a moment. So Typically, when a company pays a dividend, it means that they are in a predictable industry with predictable trends and they have a good handle on their finances because they have to plan several years out because that's EPS that is not getting reinvested into the company that they are now profit sharing with all the shareholders. So Verizon has, I think it's like 18 years of increases. I'd have to look. It's the first number that came to my mind. Very predictable business. Now, keep in mind, less than 57% of their earnings are getting paid in the dividend. Now, people look at Verizon's debt profile and they get shook because they have more debt than AT&T. It's like 140 something billion. Now, normally that would scare me, but I actually look into debt the way you guys do. So the first thing I do is Verizon has 4.2 billion shares, pay a dividend of 266. Their annual dividend obligation is $11.2 billion. Their earnings from operations in the TTM is just over $21 billion. So you have $9.85 billion in retained earnings. Now, I looked at they also have $4.92 billion cash on hand. So I looked at their debt obligations. This is not updated yet. This is from the beginning of 2023, so I'm going to put that disclaimer out there because for some reason they haven't updated on their quarterlies, but it was an annual report. So with giving myself some rope, they had $9.3 billion in debt obligations this year. Next year's big with $16.5 billion. Then you got 8.7, 8.3, and 6.9 billion. Total of roughly $50 billion in debt over the next 5 years. So when you look at this, so what I did is their debt obligation per year, what the retained earnings are, what their retained earnings are after allocating it toward the debt, and then with their cash on hand, what they have left over. So this year, if they used all their retained earnings after paying the dividend toward the debt obligation, they'd still have 572 million left. You add that to their cash on hand, they're at 5.49 billion. Next year is a huge year of debt, 16.52 billion. They can absolutely buy some of that back this year because they have enough cash on hand, probably buy it at a discount, or refinance some of it at a higher rate going into the future. If they didn't, they could issue bonds, pay it down. Next year's the only bad year. After that, you have enough. If you look at the 5 years, if they played a financial manipulation, so to speak, game of when to pay stuff off, they could finish the next 5 years eliminating 50 billion in debt and still having 4.4 billion in cash, assuming that their retained earnings, which looks pretty steady over the past several years, stays the same, and their predictable business stays predictable. Like they're not in a situation where debt is an issue. It can be serviced, and they were in a capital intensive business, and nobody's getting rid of cell phones.
There are a couple of things to add to that. If you look at Verizon in terms of just overall where they are likely to go in a recession, let me just share my screen real quick, Stephen, and then you can have it
How
back.
do I stop sharing?
I got
It's
it.
fine. I got
Oh,
you
on
can
the
keep
top,
your
yeah.
screen. Yeah. Oh, there you go.
So my thesis on Verizon is very simple. Okay. Number one, if you just look at their fixed wireless amount, the number of ads that's happening in fixed wireless is going to be amazing. So they're going to be taking, a good portion of market share because of that. So that's an entirely new business that they're going to be able to monetize. So that will help with some of the growth that's there. And so you can see here right now, they net add about 400,000 people to fixed wireless. And now that they've actually done the clearance on that, they should be actually able to address way more. So if you look at like where Verizon's like C-band is, like how many people that can actually cover, they're actually going to be able to cover by 2024 almost 250 million Americans, like based on populations that have the ability to get on it. So the total addressable market is growing exponentially. Now, one of the things is that they had to spend a lot of money on CapEx over the last 4 or 5 years in order to finance a lot of that spectrum. And also you have to put in the technology to address, to, basically allow for that to happen. So you can see here that their CapEx grew in 2022 and 2023. But the great thing is, even they've mentioned it, that their CapEx is starting to go down, right? So that means their free cash flow is going to be growing at a really fast pace. So if you look at, like, let me just bring it down here. What they're projecting out, Verizon right now is doing about, next year is projected to do about 19.25 billion in capex, and the year after that, in 2025, they're going to do about 17.5. So I mean, sorry, I think 19.5 is this year, and then next year, which is 2025, 2024, sorry, is going to be 17.5, and it's going to stay leveled off at 17.5 for a good amount of time while they're addressing their debt. Now, the one thing that you really got to look into with their debt is that they're an investment grade company, so they don't have to worry about issuing debt at like these crazy rates that other companies might have to, especially if they don't have like a good credit rating. So their credit rating is investment grade, so that helps tremendously. But this is the thing that I really wanted to emphasize: they have stock buybacks that could start happening in 2025, and the weight and the metric that they're using in order to get to the point where they can start buying back shares is that when their net debt adjusted to their EBITDA falls below 2.25%. Right now, well, when this article first came out, this was in 2022 during one of the conferences, it was trading at a 2.8 times their adjusted EBITDA to net debt. So if you go here right now, they break this out in their earnings. Right now, you see that net debt to EBITDA is at 2.6%. What you're saying, Stephen, is all that additional that free cash flow, if that goes towards the debt, that means that their net debt is going to shrink significantly, which means that any additional free cash flow is going to be able to go into their into their EPS growth. So at an EPS right now of about only 6, dude, imagine that. You have a company that's buying back shares with a single digit or PE that likely is going to start growing their EPS pretty fast. And then on top of it, right now, with all the recessionary impacts that we're seeing that the interest rates are likely to fall mid-2024, and then go to 2025, they're going to fall even further, which means even their debt servicing costs on that refinance debt that they have coming up in 2024 and 2025 is going to be at pretty decent rates. So it's not going to impact their bottom line very much. What I really like about them, though, is that they are a defensive play in the middle of a recession. Unlike other companies that are negatively impacted tremendously by higher interest rates, Verizon is a utility. No one cancels their utility. This is like one of those core things that all businesses and individuals need. And so Verizon, if you look at earlier last year, before all the rate increases, Verizon was actually trading at a pretty good pace. So even in 2022, the first quarter, they were up 5%, with the S&P was down 7 and 10%. So right now, based on just valuations, and if we do get hit by a recession, I think there's going to be a good amount of people that see the same thing and start to actually buy into Verizon. And that's one last thesis. And then one last thing, of course, when you look at Verizon yield right now on their just their stock, their dividend, it's 8.5, almost 9% yield. That means that, number one, as they grow their dividend, it's going to get better. And then at the same time, if interest rates go down, you're going to have yield chasing. A lot of people don't realize that what happens is right now you can get a risk-free return of about 5.25% from the Treasury for a 2-year Treasury. That's fine. The problem is when that Treasury ends up, and when they start cutting rates, then goes down to 3 or 4 or even 2, people aren't going to say, yeah, I'm willing to just accept a 2% return. Fund managers can't accept a 2% return. Right now, they can do 5.5%. That's fine. But eventually, they're going to need to make money. So what are they going to do? They're going to do what they always did. They're going to yield chase, and they're going to buy up companies like Verizon. And basically now you're going to have, in my opinion, Verizon jump up to like at least $10, $15 dollars from where it is today. So you're looking at maybe like $45 to $50 a share in stock price, on top of an amazing dividend that you're going to be collecting that's going to be growing, with a company that's possibly going to be buying back shares in 2025. So, like I
Yeah.
said, this one's a no-brainer in my opinion.
My question is would it be prudent for them to, now I'm not exactly sure if they were to go to the market, what somebody would pay them in terms of an interest rate on some of these bonds. My question would be to you guys is, what do you think it'd be smarter for them to hold cash now rather than paying down some of this debt, so that they could actually grow their cash pile and really just try to hold off until they can refinance at some of this debt at an even lower rate? Now, you'd think it'd be more prudent for them to pay off the debt now rather
They
than
need to get that debt level under 100 billion. That's a critical level for them, because then their debt to EBITDA ratio declines significantly, and it gets a much different view in the investor eyes.
But that's a net debt, right? So you have to think net debt is technically whatever the debt load is minus cash divided by what the EBITDA is. So technically, either way, if they were to knock out the debt, I know exactly what you're saying, right? But
Yeah.
I'd look at it because my company uses gearing ratio, and I think a lot of European companies use gearing ratio rather than like debt to EBITDA and stuff of the like. But
Matt, you got to remember that a lot of investors and a lot of people that discuss these stocks are looking at their debt load. And that's one of the big red flags about Verizon. Everybody knows that they're generating tens of billions in free cash flow. Everybody knows that they're a dividend machine, but they're seeing the lack of earnings growth and the high pile of debt. They need to take the debt off the table so that becomes a non-factor. Then there's nothing left to complain about. And to echo what Chris said, and I've been writing about this quite frequently because I think a lot of people are missing this point. Right now, you have rates at the highest they've been since the early 80s. You're getting 5.5% on a 12 month. You're getting almost 5%. I think it's like 5.9% on a 10-year. Now, I have cash in CD. Sure, other people have non-risk assets. But when the Fed starts cutting, and as I showed on Finance Junkies, it looks like the middle of 2024 is when the shift in the projections comes. When the risk-free rate of return starts declining, and that sweet spot of, okay, now it's only a 4.5%. Maybe I'll roll it one more time if I'm in a 6-month or a 9-month CD. But once it starts getting to 4% or 3.5% yield,
people are going to start moving into
risk-free rate of return no longer becomes that attractive, especially when you say, okay, well, I can get 8.5% average in the S&P over a period of time on appreciation. But if I'm looking for income, that risk-free rate's no longer servicing my needs. And when money rolls out, there's over $5 trillion in money markets. It's going to flow into income-producing assets, because anybody that's putting money into a CD or a T-bill, they're not necessarily just waiting it out. They're generating income. They're most likely looking for income. And that's going to go into, my opinion, Altria, which is one of the most interesting stocks, Verizon, AT&T, and some REITs that have gotten hit pretty hard. Chris and I are going to disagree about one of them, and we'll agree about one of them. But you're going to have, over the next probably 12 to 18 months, when rates start coming down and continue to get cut, especially, don't forget, we're going into an election year. There's going to be so much pressure on the Fed to cut rates going into that election. We may see a jump with the cuts. And the money's going to go somewhere, and it's probably going to go into income-producing assets.